Welcome, curious minds, to the deep dive. I want you to step into a lab with me for a moment. Picture a scientist, maybe a brilliant researcher hunched over a microscope. They're meticulously examining cell after cell on a glass slide day in, day out. It's, an iconic image, a powerful symbol of human skill and dedication in science. But here's the fascinating truth. Even in highly skilled fields like medical diagnostics, those deeply human, often manual processes of yesterday, well, they're rapidly being replaced by cutting-edge technology. It's a quiet revolution, yes, but one that is profoundly reshaping how we diagnose and fight disease. Today, we're taking a deep dive into a company right at the forefront of that transformation. CellaVision AB. They're a Swedish medical technology pioneer, and their mission is basically to revolutionize laboratory medicine. How? By replacing that traditional manual microscopy, especially in the field of hematology, that's the branch of medicine focused on blood and blood-related disorders, with highly automated digital systems. Think about the massive impact of that. Enhancing the certainty of diagnoses, dramatically streamlining lab workflows, and ultimately playing a critical role in the fight against serious conditions like cancer.
And our mission for you today, as we navigate through an in-depth investment research analysis of CellaVision, is, well, to extract the most critical insights. We're going to examine everything from their truly innovative business model and the intensely competitive landscape they navigate to their robust financial health and their compelling future growth opportunities. The goal is for you to walk away with not just facts, but a crystal clear understanding of this specialized yet globally impactful field and its real-world implications.
Okay.
So let's unpack this journey, from its origins as a focused Swedish startup to becoming a global standard bearer. CellaVision's story offers a compelling look into how genuine, sustained innovation doesn't just improve existing processes. It fundamentally disrupts and redefines even the most traditional corners of healthcare.
Absolutely. It's a fascinating case study.
To understand how CellaVision built this leadership, we really need to go back to their foundational story in Lund, Sweden. The company was established in 1994.
Right, 1994. So they're actually celebrating 3 decades of continuous innovation this year in 2024. Wow, 30 years. That's a significant milestone for any tech company, particularly in the demanding medical field.
It really is. And they've truly evolved from, a focused startup into a publicly traded entity, now listed on NASDAQ Stockholm mid-cap. Quite a remarkable trajectory.
Especially for a company tackling such a specific yet absolutely critical need.
What's truly insightful here, I think, is how a singularly clear and focused mission can be the engine for 3 decades of market leadership. From its very inception, CellaVision's core mission has been to digitalize medical microscopy, specifically within hematology.
The study of blood and blood diseases, right?
Exactly. And this isn't merely about achieving faster results, though that's certainly a benefit. It's profoundly about improving the accuracy and reliability in diagnosing critical conditions. We're talking about everything from quickly identifying common infections, where a precise blood analysis guides immediate treatment, all the way to early and accurate detection of serious hematological malignancies.
Like leukemia and lymphoma.
Precisely. Where timely diagnosis can be absolutely life-changing for patients. Their solutions don't just streamline labs. They genuinely elevate the standard of healthcare quality.
And when we talk about CellaVision, we're not just discussing a single instrument or piece of software, are we? You mentioned they've deliberately constructed a comprehensive ecosystem.
That's the key word, ecosystem. It's a well-thought-out business model designed to offer a complete workflow solution for hematology labs. Very integrated. It comprises 3 main components that work together: their sophisticated hardware, their intelligent software, and the essential consumables.
Okay, let's start with the hardware then. The physical instruments, that's often the most visible part, I guess.
Right. They have 2 primary instrument platforms. The flagship is the CellaVision Di60. This is their robust workhorse designed for the very high throughput demands of large university hospitals, central reference labs, places processing massive volumes of samples quickly and precisely.
And the other one?
Then, in 2019, they introduced the CellaVision DC1. This is a more compact, more accessible system. Its launch was a really strategic move because it specifically targets that vast, traditionally underserved market of small and medium-sized labs globally.
Ah, so that really expanded their potential customer base significantly.
Hugely. It instantly expanded CellaVision's total addressable market.
Now, a particularly compelling aspect you mentioned is the diversified revenue streams. It's much more than just selling those impressive machines once, right?
Exactly. While instrument sales are certainly a component, they are complemented by 2 incredibly important recurring revenue streams. First, there are reagents. These are the chemical solutions, the stains essential for preparing blood samples. Labs buy these continuously.
And they got a boost here from an acquisition.
Yes, a significant strategic boost from their 2019 acquisition of RLL Diagnostics, a French reagent manufacturer. This was a smart move in vertical integration, bringing a crucial part of the supply chain in-house.
Okay, so they control the quality better.
Right. By controlling the quality of these staining reagents, CellaVision ensures higher quality inputs for its image analysis algorithms, improving the overall diagnostic performance. And crucially, it also captured a valuable, predictable, recurring revenue stream.
Makes sense. And the third category?
The third category, software and other, also provides consistent recurring revenue. This includes various software applications for things like remote access for specialists, competency testing for lab staff, and ongoing service contracts and spare parts. This layered approach truly underscores how they've built a robust, sort of sticky business model where customers remain engaged long after the initial sale.
So it's not just selling a box.
Not at all. If we connect this to the bigger picture, what you see is a very deliberate strategy to control the entire diagnostic chain. This integrated ecosystem is fundamentally underpinned by CellaVision's deep expertise and core competencies: precise sample prep, advanced digital image analysis, sophisticated AI, and automated microscopy.
These are the foundation.
They absolutely form the bedrock of CellaVision's competitive advantage. It's their continuous mastery and innovation in these complex areas that enable them to consistently deliver on their mission.
So how does a highly specialized Swedish medtech company like this actually reach labs all over the world? What's their go-to-market strategy?
Yeah, it's quite smart, actually. They employ a very scalable indirect sales model. They achieve this by leveraging a vast network of global distribution partners. These are typically major players in the broader lab diagnostics industry.
Like Sysmex Corporation you mentioned?
Exactly. Sysmex is a key example, a global leader in hematology analyzers. These partners handle the primary sales, marketing, and often the initial customer support in their regions.
And the big advantage there is?
Significant operating leverage. They can grow revenues without a proportionally large increase in operating costs. They get broad market access without the huge fixed costs of building and maintaining their own massive direct global sales force. It's very capital efficient.
But is it purely indirect?
Yeah.
Or do they have some boots on the ground?
That's a great clarification. It's not purely indirect. CellaVision complements this with its own local market support teams. They've actually expanded this quite a bit, now with 12 offices covering over 40 countries.
Okay, so what do these teams do if they're not selling directly?
Their role is crucial. They support the distribution partners with specialized knowledge. They engage with key opinion leaders in the medical community to drive adoption. And they provide essential advanced training and technical support directly to the end users in the lab.
So it's more of a hybrid approach then.
Exactly. This hybrid approach ensures they stay connected to the market while maintaining that financial efficiency. It's a smart balancing act.
But that reliance on partners, it sounds efficient, yes, but also maybe a source of strategic risk, like a double-edged sword.
You've hit on a critical point. It absolutely is. Maintaining control and predictability is a constant challenge. There's the operational risk if a key partner changes strategy.
Yeah.
Remember the 2021 termination of the distribution agreement with Mindray?
Right, and Mindray then became a more direct competitor.
Exactly. But even aside from major shifts like that, seemingly mundane things like distributor inventory management can cause issues.
How so?
Well, if distributors stockpile products in one quarter, maybe anticipating future demand or price changes, it can temporarily inflate CellaVision's sales that quarter.
And then make the next quarter look weaker, even if underlying demand is steady.
Precisely. It creates lumpiness and short-term volatility in reported sales, sometimes masking the true end market demand.
So the health of those key partnerships, especially with Sysmex, is absolutely vital.
Critical. The relationship with Sysmex forms the backbone of their market reach. Its stability is paramount for their continued success and predictable revenue.
Let's zoom out for a moment then. Give us a sense of the overall market CellaVision operates in. How big is this global hematology diagnostics space?
It's substantial. While estimates vary a bit depending on the source, the consensus puts the global hematology diagnostics market somewhere between, say, $4.1 billion and $8.4 billion for 2023-2024.
Wow, that's a wide range, but definitely billions.
Definitely billions. And it's not stagnant. It's projected to keep expanding at a compound annual growth rate, a CAGR, of somewhere between 3.3% and 6.7% through the end of the decade.
Okay, so not explosive growth, but mature, stable, and consistently growing.
That's a good way to put it. It signals a mature but consistently stable sector driven by fundamental healthcare needs that aren't going away.
And how is this market typically broken down? You mentioned segmentation earlier.
Right. Understanding these segments is key to seeing why CellaVision's recurring revenue streams are so crucial. First, you can segment by product, instruments versus consumables. Consumables include reagents, stains, controls.
Stuff labs use up and need to reorder constantly.
Exactly. And that consumable segment is often identified as both the largest and the fastest growing portion of the market. It just makes sense once an instrument is in place, the recurring purchases begin.
And the other segmentation, end users.
Yes, by end users. The vast majority of testing volumes are handled by large hospital laboratories and independent diagnostic labs. That's where the bulk of the market sits.
So what's actually fueling this continued durable growth in what's already a pretty big market? Are there specific long-term trends?
Oh, yes. Several powerful long-term macro trends act as a consistent tailwind here. First, the aging global population. As societies, especially in developed nations, see more elderly individuals, this group naturally has a higher incidence of chronic diseases and blood disorders. More older people means more testing.
Simple demographics driving demand.
Pretty much. Second, there's a rising burden of disease. We're seeing an increasing global prevalence of hematologic conditions, blood cancers like leukemia and lymphoma, widespread disorders like anemia. This rise fuels demand for fundamental tests like the complete blood count, the CBC.
Which is often the first step in diagnosis.
Often, yes. But perhaps the most critical driver, the one creating an urgent fundamental need for the automation CellaVision provides, is the economic and operational pressures on laboratories themselves.
Tell me more about that. What kind of pressures?
Modern clinical labs are operating in an incredibly challenging environment. They're facing steadily increasing test volumes, more patients, more tests, and growing case complexity requiring more nuanced diagnostics. But most critically, there's a severe global shortage of skilled laboratory professionals, hematopathologists, medical technologists. There just aren't enough of them.
Right, I've heard about these staffing shortages in healthcare.
It's acute in labs. And this creates an undeniable urgent need for solutions that can automate manual processes, drastically improve efficiency, and increase productivity from the staff they do have.
And that's where CellaVision comes in.
That's exactly what CellaVision's digital solutions are designed to deliver. It hits right at that pain point.
Let's talk more about that seismic shift happening inside these labs then. You mentioned the traditional method, manual microscopy. Describe that a bit more.
Well, for centuries, it's been the standard. Imagine relying on just one pair of human eyes, peering through a lens at countless cells day in, day out.
Incredible skill, but sounds exhausting and maybe subjective.
Exactly. It's an incredible human effort requiring immense training and focus, but it's also a significant limitation. It's notoriously time-consuming, inherently subjective, and crucially, prone to variability between different observers. What one skilled tech sees, another might interpret slightly differently. It's a bottleneck and a source of potential inconsistency.
A major limitation for critical diagnoses.
Definitely. And that's precisely where digital cell morphology, pioneered by CellaVision, steps in as the truly transformative solution. It's a complete paradigm shift, from subjective manual review to objective cell analysis.
This worked practically.
It leverages high-resolution imaging, precision robotics, and sophisticated AI to automate blood smear analysis. Instead of a human eye scanning every cell on a slide, AI algorithms automatically locate, pre-classify, and then efficiently present only the most relevant or abnormal cells to a technologist for rapid verification on a screen.
So it flags the important stuff for the human expert.
Exactly. It guides their attention. This isn't just an incremental improvement. It's a fundamental change in how labs operate, drastically improving both speed and consistency.
And the concrete benefits for the lab and ultimately the patient.
They're really transformative. First, enhanced accuracy and standardization. AI provides consistent, objective cell classification, reducing that human variability, leading to more reliable diagnoses.
Okay, that's huge. What else?
Second, improved efficiency. Automation can boost overall workflow efficiency by up to 60%. Labs can handle significantly higher test volumes with their existing staff, directly addresses that personnel shortage.
Right, doing more with less, essentially.
Pretty much. And third, powerful remote capabilities. Digital images can be securely shared across networks. This enables telehematology.
Meaning remote review.
Yes, remote review by specialists, expert consultations from anywhere. Vital for large lab networks or facilities in remote areas lacking on-site specialists. It democratizes expertise in a way.
That's a really significant advantage.
It is. So what does this all mean? CellaVision isn't just selling equipment. It's a key enabler of a new digital standard of care. And it has these powerful, long-term market trends, secular tailwinds propelling its growth. This isn't a fad, it's the profound structural shift.
An irreversible transformation, you're saying?
I believe so.
Yeah.
Driven by those economic and demographic forces pressuring labs worldwide, they have to automate. CellaVision's offering becomes increasingly essential, not just desirable.
Okay, let's broaden the view again. Who else is playing in this space? What does the competitive landscape look like?
Well, if you look at the entire hematology diagnostics market, it's quite concentrated, dominated by a few major diversified IVD in vitro diagnostics giants.
The big names.
Right. Think Sysmex, Danaher through Beckman Coulter, Abbott Laboratories, Siemens Healthineers. These titans offer comprehensive end-to-end solutions for labs. Their core business is often those high-throughput analyzers.
But CellaVision's focus is narrower, right?
Exactly. Within that broader market, CellaVision carves out and dominates a specialized niche, digital cell morphology. And in this segment, they are the clear established global market leader. Their tech is widely regarded as the gold standard.
A reputation built over 3 decades.
Painstakingly built, yes, setting the benchmark for accuracy and efficiency.
But even a gold standard faces competition, presumably. Is it heating up?
It is intensifying, yes. We're seeing a few key players emerge or become more aggressive. Shenzhen Mindray Biomedical Electronics, the major IVD player from China, they've developed their own integrated digital morphology solution, the MC80 analyzer.
And that's a significant threat.
It poses a significant threat, especially in APAC and other price-sensitive markets where an integrated single-vendor solution can be very appealing.
Are there others? Smaller players?
Yes, and it's not just the big guys. Smaller innovators are entering the space too. Companies like Scopio Labs from Israel, West Medica from Austria, they're bringing new technologies like full-field imaging, trying to challenge the status quo.
So with these big players integrating and smaller innovators emerging, how does CellaVision maintain its lead? What's their moat?
They've built a formidable moat, yes. A set of strong competitive advantages protecting their dominant position. Let's break it down. First, a powerful first-mover advantage and a massive installed base. As a pioneer, they have over 8,000 units installed globally.
8,000, that's huge.
It's a huge footprint, and it creates significant customer stickiness. Labs integrate these systems deeply into workflows. Switching is hard and costly. Plus, it generates recurring revenue software, service, reagents.
Okay, what else?
Second, their brand recognition and clinical trust. This is massive. The fact that all 20 of the top-ranked hospitals in the United States use CellaVision technology.
That's a powerful endorsement.
It's an incredible endorsement, a huge barrier for new entrants. Third, their proprietary technology and advanced AI algorithms. We're talking sophisticated AI refined over decades using vast data sets, protected by a robust patent portfolio, which they actively strengthen, like with the 2021 purchase of the FPM patent portfolio.
FPM, Fourier ptychographic microscopy. We'll come back to that.
We will. And finally, a truly critical part of their moat: deep integration with key partners. CellaVision's tech isn't just sold by major manufacturers. It's often deeply embedded within their systems, especially Sysmex.
How does that work with Sysmex?
Well, the Sysmex DI60 digital imaging system, for example, is based on CellaVision's technology platform. This effectively makes CellaVision the default digital morphology solution for a large chunk of the global market. It's more than distribution. It's a deep technological partnership.
But that raises an interesting point. These big partners like Sysmex are also potentially their biggest competitors, aren't they? How does that dynamic work?
You've put your finger on the complexity. It's absolutely true. These large analyzer manufacturers are simultaneously CellaVision's most vital distribution channels and its most significant long-term competitive threats.
A tricky position.
Very tricky. While the deep, almost OEM-like relationship with Sysmex provides unparalleled market access, it also creates a structural dependency. The primary long-term competitive threat isn't necessarily a small startup with slightly better tech, but the risk of bundling by these IVD giants.
Meaning they integrate their own digital morphology into their main analyzers.
Exactly. As they develop next-gen platforms, they might integrate their own good enough digital morphology. Mindray did this with the MC80. Abbott's Alinity Hay series seems to be moving that way too.
So a lab buying a whole new line might be tempted by the convenience of a single vendor.
Precisely. Is the single vendor convenience good enough, or is CellaVision's specialized gold standard truly superior and worth integrating separately? That's the question for labs.
So CellaVision's defense relies on maintaining that technological superiority, brand strength, and the deep integration, especially hoping partners like Sysmex see more value in collaboration.
That's the strategic tightrope they walk. The tech lead and deep Sysmex integration create a kind of collaboration barrier, making it arguably more beneficial for Sysmex to partner than to spend billions trying to replicate CellaVision's expertise. It's a powerful, albeit complex, defense.
All right, let's turn to the numbers. A company's financial performance often tells the real story. What are CellaVision's long-term financial goals?
They have clear ambitions, aiming for about 15% average annual sales growth over an economic cycle, while maintaining a robust EBITDA margin exceeding 30%.
Okay, 15% growth, 30% plus EBITDA margin. How have they actually performed against those targets?
Well, looking at their history, what stands out is that they've consistently hit or exceeded that profitability target, which is impressive. But achieving that ambitious 15% growth goal has been more variable.
So profitability is strong, growth is lumpier.
Exactly. Reported sales growth has fluctuated quite a bit. Strong expansion periods, like 27% in 2019, and a big post-COVID rebound in 2021 with 24% organic growth. But more recently, organic growth moderated 4% in 2022, actually negative 1% in 2023, before a modest recovery reported at 6.8% in 2024.
So recent performance hasn't consistently hit that 15% target. What does that suggest? Maybe maturation in their core large lab markets?
That's certainly a plausible interpretation. It suggests growth from penetrating large labs in developed regions might be slowing somewhat.
Which makes those newer initiatives even more critical.
Absolutely. But in stark contrast to that top-line variability, their profitability has been remarkably stable and robust. This really showcases the high operating leverage from their indirect sales model. They've consistently delivered EBITDA margins at or above that 30% target. Figures like 32.5% in 2018, 31.8% in 2019, consistently around 30-31% recently.
So even when sales fluctuate, the profits remain strong.
That high operating leverage is a core strength. It delivers consistent, strong profits.
Just glancing at their financial summary. Net sales show that varied growth. Gross margin looks incredibly stable, around 67-69%.
Yes, very stable, excellent gross margins.
EBITDA and net income clearly show that consistent profitability. And cash flow from operations looks consistently strong too.
Yes, consistently strong operating cash flow, which is a fantastic sign of a healthy, self-sustaining business.
So what is this divergence between the growth target and recent performance signal for the future? You mentioned a potential growth gap.
Right. It suggests the historical driver large lab penetration might not be enough on its own to consistently deliver 15% growth anymore. Future growth really depends significantly on successfully executing those newer strategic initiatives. The DC-1 for smaller labs, the upcoming bone marrow module.
We'll definitely dig into those. So success hinges on opening and expanding these new fronts.
That seems to be the key takeaway from the recent numbers.
Okay, let's dive deeper into their geographic performance. Where is the growth coming from or not coming from?
It's fascinating, actually. Their sales are globally diversified, which is a strength, but each region tells a very different story. The Americas, particularly the US and Canada, has been a consistent engine. Strong 34% growth in 2022, another robust 12% in 2023.
What's driving that strength in the Americas?
Largely that acute shortage of skilled lab personnel we discussed. It really accelerates the need for automation there.
Okay, what about EMEA, Europe, Middle East, Africa, their home turf?
That's a more mature market. Growth has been solid but more moderate, 11% in 2022, then a slight 1% dip in 2023. But it shows steady adoption, especially for recurring region sales.
And APAC, Asia Pacific, you mentioned potential but volatility.
Exactly. Greatest long-term potential but most volatile. A significant 24% sales decline in 2022, then a rebounded with 10% growth in 2023. But a particularly compelling highlight was Q2 2025 exceptionally strong 27% organic growth in APAC.
Wow, 27%. What drove that spike?
Largely driven by a strategic Made in China initiative with a local partner involving high volumes of instrument modules.
So Global trends and local strategies playing out very differently, region by region. Opportunity and risk.
Precisely. America's fueled by staffing shortages. EMEA stable with recurring revenue. APAC volatile but huge potential, requiring tailored strategies like Made in China. It shows their adaptability.
Now let's talk financial backbone. Cash flow and balance sheet. You said cash flow is strong.
Incredibly strong and consistent. They generated SEK 198 million from operations in 2024, SEK 196 million in 2023. Very similar, very robust.
And why is that so crucial?
Because it funds everything else, R&D, potential acquisitions, shareholder returns, all without relying heavily on external debt. It gives them flexibility.
And the balance sheet itself.
Exceptionally strong. An equity ratio of 81% at the end of 2024, mostly financed by equity, not debt. Financial debt is minimal, only SEK 6 million in bank loans, and excellent short-term liquidity, a current ratio of 3.19.
So plenty of assets to cover short-term liabilities.
Exactly. This robust financial position provides substantial flexibility to navigate uncertainties and proactively pursue growth, which is a huge asset.
Okay, let's bring our focus to the more recent past. The challenges and performance between, say, 2023 and mid-2025. How did Q2 2025 look?
Q2 2025 showed net sales of SEK 191 million. That translated to a robust organic growth rate of 7.6%.
Okay, 7.6% organic. How did that compare to expectations?
It was actually slightly below the analyst consensus forecast of SEK 192 million, but still a solid underlying performance for the quarter.
And regionally? That strong APAC number came through.
It did. APAC posted that impressive 27% organic growth, mainly from those instrument modules to the China partner. Americas delivered a solid 5% organic, while EMEA was more modest at 1% organic.
And profitability, did that hold up?
It did. Profitability remains squarely on target. An impressive 31% EBITDA margin for the quarter shows consistent operational efficiency. And what's more, they showed very effective working capital management, generating strong operating cash flow of SE 58 million, helped by reducing inventory and receivables.
So a well-managed operation delivering cash even with external pressures.
Yes, the underlying business momentum seems solid.
But it hasn't been smooth sailing, right? There have been headwinds.
Definitely. Recent performance has been significantly shaped by several macroeconomic and operational headwinds. Currency fluctuations have been a persistent and significant issue, often masking the true organic growth strength.
How much of an impact?
Well, in Q2 2025, organic growth was 7.6%, but reported sales growth was only 1.9%. That's a negative currency impact of 5.7 percentage points.
Wow. So the strengthening Swedish krona made their international sales look lower when converted back.
Exactly. It really underscores why we need to look at those organic growth figures to see the real operational performance, stripping out that currency noise.
What other headwinds? Supply chain.
Yes. Ongoing supply chain constraints. They've openly identified potential delays in critical component deliveries, particularly from China, as an ongoing risk.
Those distributor inventory cycles.
They continue to introduce lumpiness. Sales in EMA in late 2024, for example, were hit because distributors had built up inventory earlier, leading to fewer orders later. Reduces quarterly predictability.
Let's circle back to that Made in China initiative driving APAC growth. You said it's a proof point, but also carries risk.
Precisely. It's vital proof they can adapt to penetrate high-growth emerging markets, a potential template for other regions. However, it also increases dependency on the Chinese market, exposing them to greater geopolitical risks. And long-term, there's the potential risk of fostering a capable local competitor if that partner eventually develops their own tech.
A delicate balance then, opportunity versus strategic hazard.
Absolutely. And on a management note, there was the departure of their CFO, Magnus Blixt, in July 2025.
Right. A change in a key role like CFO always introduces some uncertainty during the transition.
Yes, requires careful navigation, especially in a dynamic market.
Okay, let's talk about where the money goes. How does CellaVision approach capital allocation? What's their financial strategy?
It's characterized by a very disciplined and balanced approach. They clearly prioritize internal investment for organic growth, strategic M&A to strengthen their position, and consistent returns to shareholders.
A thoughtful blend for sustainable value. How does that translate into dividends?
They have a clear policy: distribute 30–50% of net profit, considering investment needs. And this has led to a steadily growing dividend. It went from SEK 1.50 per share in 2018-2019 up to SEK 2.25 for 2023, with a proposed increase to SEK 2.50 for 2024.
That's a decent increase.
It's an 11.1% year-over-year growth for the 2024 proposal, supported by a very sustainable payout ratio around 39%. Reflects confidence in long-term earnings.
Do share buybacks as well?
They maintain authorization. The AGM consistently grants the board authorization to repurchase up to 10% of outstanding shares. The stated purposes are capital structure flexibility, enhancing shareholder value, having shares for acquisitions or employee programs.
But they're not actively doing large systematic buybacks right now.
Correct. It seems to be more about maintaining that strategic flexibility for opportune moments rather than a major ongoing program.
Okay, let's look at investment and M&A. They've made some interesting moves there. The RAL Diagnostics acquisition in 2019.
Yes, that was a key strategic move. Vertical integration into sample preparation, the staining process.
Why was that so important?
Two main reasons. One, controlling staining ensures higher quality inputs for their image analysis algorithms, improving system performance. Two, it added that valuable high-margin recurring revenue stream from reagents, solidified the razor and blades model.
It makes perfect sense. Then, in 2021, they bought that FPM patent portfolio. Fourier Tychographic Microscopy. Tell us more about that.
Right, for SE10, $28.7 million. This is a novel microscopy technology. Think of it like a computational super zoom. It takes many lower-res pictures from different angles and digitally combines them into one incredibly high-res image, way beyond what traditional microscopes can do without massive, expensive lenses.
Wow, so a potential game changer.
Potentially, yes. It's a long-term bet, creating a platform for future growth. The applications could go beyond hematology into digital pathology, tissue biopsies, and cytology examining individual cells. Much larger markets, potentially.
So strengthening the core and investing in next-gen tech. And R&D spending reflects this.
Absolutely. R&D is a cornerstone. Spending is consistently high and actually increasing. Q2 2025 saw R&D expenses rise to 22% of sales, up from 19% the year before.
That's a significant chunk of sales.
It is, and a significant portion is capitalized, reflecting investment in major projects like the bone marrow application and that long-term FPM platform. Ensures they stay at the cutting edge.
So summarizing their capital allocation, near-term synergistic M&A like RAL, plus long-term venture-style bets like FPM, all funded by strong internal cash flow.
Exactly. Enhancing their current moat while planting seeds for the next decade of innovation. It's a sophisticated, two-pronged approach.
Okay, let's look ahead then. What are the main growth opportunities and strategic priorities for CellaVision going forward?
Their strategy is clearly multifaceted, built on 5 key pillars, really. Maximizing their existing leadership in large labs, accelerating adoption of the DC-1 system, strategically growing the reagent business, expanding into new specialized analyses, and exploring entirely new areas through innovation like FPM.
Let's focus on penetrating that small to medium lab segment with the DC-1. You said that was significant.
Undeniably one of the most significant growth opportunities. It's a vast, largely underserved market, estimated 100,000 labs globally, with historically low digital morphology penetration, too costly or complex before.
And the DC-1, launched in 2019, was designed specifically for them.
Exactly. Smaller footprint, more accessible price point. Crucially, it got U.S. market clearance in late 2020. Accelerating DC-1 adoption is now a top priority. It significantly expands their total addressable market.
And the high-margin reagent opportunity, growing that blades business.
Right. The RAL acquisition transformed them into an integrated solutions company. Building global leadership in reagents is now a core strategy. It creates that classic razor and blades model. Sell the instrument, then generate consistent high-margin recurring revenue from the reagents labs must repurchase. Provide stable, predictable revenue that grows with the installed base.
And how's it performing?
Encouragingly, reagent sales grew 7% in Q2 2025, led by a strong 20% increase in hematology reagent sales, specifically in EMEA. So, traction there.
Okay, now the R&D pipeline. You mentioned the bone marrow application is a near-term catalyst. What exactly is this?
This is probably the most significant and tangible near-term catalyst. It's a new software module designed to automate the analysis of bone marrow aspirates.
Which is currently done manually.
Almost entirely manually. It's a highly complex, specialized diagnostic procedure. Automating it would be a huge step.
And the timeline, where are they with this?
Final stages of clinical trials currently. Progressing towards regulatory submission. They anticipate getting a CE mark in Europe by early 2026, with commercial launch planned for Q1 2026.
So, potentially launching within about 18 months. Why is this so transformative?
Several reasons. One, it expands CellaVision into a new, high-value clinical area beyond peripheral blood smears, diversifies their utility. Two, as software on existing hardware, it should carry very high gross margins, boosting overall profitability. And maybe most importantly, it serves as a crucial proof of concept for their strategy of expanding into other specialized microscopy analyses, de-risks future growth initiatives.
So it's not just a product, it's a strategic stepping stone.
Exactly, a very important one.
And looking even further ahead, that long-term vision with FPM Fourier tychographic microscopy.
Yes, the long-term bet on next-generation technology, pushing the boundaries of automated microscopy for future hematology solutions.
But potentially beyond hematology too.
That's the really exciting part. While commercialization is years away, imagine FPM enabling entry into vast adjacent fields like digital pathology analyzing tissue biopsies or cytology examining individual cells for cancer screening, etc.
Those are huge markets.
Massive. Success here could fundamentally redefine CellaVision's market scope, moving them from a niche leader to a broader digital diagnostics powerhouse, dramatically expanding their total addressable market. It's the long game.
Of course, no path is without obstacles. What are the key risks and headwinds CellaVision faces?
There are several categories. First, operational risks. We have to reiterate that long-term dependency on distribution partners. A key partnership loss or shift could really hurt sales and market access. Remember Mindray?
And supply chain.
Yes. Reliance on third-party manufacturers and the broader supply chain, especially potential disruptions from China, is an ongoing risk.
Okay, what about market and competitive risks?
Competition is intensifying, especially from those integrated offerings by large IVD players like Mindray. This could lead to price pressure, market share erosion, particularly in price-sensitive regions. Plus, the clinical lab market is inherently conservative. Slow adoption, long sales cycles, and potential delays from cost containment in public healthcare systems.
And financial risks. You mentioned currency earlier.
Foreign exchange exposure is significant. Invoicing in USD but reporting in SE means a strong SE kit's reported revenue and profits, masking organic growth. They're also sensitive to broader economic downturns impacting healthcare budgets and capital spending by labs.
Finally, regulatory and IP risks.
Yes, products are medical devices, lengthy, complex regulatory clearances needed, FDA 510K, CE marking. Delays can postpone launches, and IP risk, relying on protecting their tech, facing costly patent litigation potentially.
So if you put all these factors together, conservative customers, long cycles, partner dependency it creates.
An inherently lumpy revenue profile. Distributor orders are often large and infrequent. The timing of one big order can swing a quarter's results. This makes short-term performance hard to predict and can lead to stock price volatility even if the long-term health is fine.
Okay, let's switch gears to valuation. How is the market pricing CellaVision currently? What do the key metrics look like? Late 2025 context.
Right. As of late 2025, market cap is around SEK 4.29 billion. Enterprise value about SEK 4.16 billion, reflecting their net cash. Valuation multiples, price to earnings ratio is about 28 times trailing earnings, maybe closer to 24 times forward earnings estimates. EV sales is around 5.5 times and EV/EBITDA about 18.2 times.
And what are analysts saying? Any price targets?
Analyst consensus average one-year target is around SEK 225.00. That represents about a 26.5% potential increase from the current share price, around SEK 178.5. Suggests analysts see upside.
Now, how does this valuation stack up against its peers? Sysmex, Danaher, Abbott, Mindray.
That comparison is really revealing. CellaVision trades at a significant EV/EBITDA premium to its key partner, Sysmex 18.2x versus Sysmex's 9.6x. But it's at a discount to faster-growing, diversified giants like Danaher and Mindray. EV sales is roughly in line with Abbott, lower than Danaher and Mindray.
So why that big premium over Sysmex specifically?
That's the key question. It seems justified for a few reasons. CellaVision is a pure play focused entirely on the high-growth digital morphology niche, expanding faster than the overall hematology market due to tech adoption and automation needs. They also have superior profitability, that 28.8% trailing EBITDA margin, targeting 30%, versus Sysmex around 25%. Plus, CellaVision's smaller size means pipeline products, like bone marrow, are much more significant potential growth catalysts relative to their base.
So the market is pricing it as a high-quality, niche growth leader, warranting that higher multiple relative to Sysmex.
That seems to be the rationale baked into the valuation, yes.
Okay, for those of us tracking this company or just curious about this space, what specific metrics should we keep a close eye on? Where does it get really interesting?
Good question. Let's break it down into operational, financial, and strategic KPIs. Operational KPIs. The most important is regional organic growth rates, quarterly. strips out currency noise, shows the real underlying momentum, especially watch APAC.
Okay, organic growth.
Yeah.
What else operationally?
Instrument placement mix, DC1 versus large analyzers, key for validating success in that small-medium lab segment. Are they winning there? And Regent sales growth, crucial measure of recurring revenue and the stickiness of the installed base, shows the Blade strategy is working.
Got it. Now, financial KPIs.
Keep an eye on the EBITDA margin. Ensure it stays at or above that 30% target, confirming business model strength and efficiency. Operating cash flow, essential gauge of earnings quality and capacity to fund future growth. Is the profit turning into cash? And R&D spend, as percent of sales and the capitalization rate, gives insight into the pipeline intensity and development stages of major projects like FPM and bone marrow.
Makes sense. Finally, the strategic KPIs. These feel more forward-looking.
Exactly. Number one here is the bone marrow application timeline. Any news on clinical trials, regulatory submissions, CE mark, FDA, and hitting that Q1 2026 launch target will be a major catalyst.
What else strategically?
Updates on FPM development. Progress reports on this long-term project are important for assessing their next-gen platform delivery. And major partner announcements. Any changes in the Sysmex relationship or new partnerships would be significant for market access and competition.
So tracking these metrics helps understand not just what they're doing, but why it matters and how successfully they're navigating.
Precisely. It helps gauge if they're meeting their strategic objectives in this evolving healthcare landscape.
So as we wrap up this deep dive, we've seen CellaVision's incredible journey, a pioneering force, really, in digital cell morphology, transforming a century-old practice with AI and automation. They've built a robust business model, a strong competitive moat, and have a truly compelling vision for the future of diagnostics.
And in essence, CellaVision really exemplifies how focused innovation can tackle critical healthcare challenges, especially that global shortage of skilled lab professionals. We've seen how they're replacing laborious, subjective work, making diagnostics more accurate, more efficient, and ultimately more accessible for you and everyone relying on those results.
So what does this all mean for the future? Not just for CellaVision, but for global healthcare. How quickly can the traditional lab truly go fully digital? And what does that accelerating shift mean for diagnostic speed, accuracy, and maybe even health equity across the globe? It's a powerful thought to mull over, isn't it?
It really is. The implications are potentially huge.
We hope you've enjoyed this deep dive into CellaVision. Keep digging, keep asking questions, and most importantly, stay curious. We'll catch you on the next one.